All the indicators you want to look at were very weak other than for central banks. So it was central banks who were buying gold, and they were not buying gold as an investment because of the investment scenario, because the investment environment of interest rates going up and a strong dollar is, of course, negative for gold. They were buying as an insurance. And when you're partly, mostly as a protection against the dollar, weaponization of the dollar. So when you're buying with that objective in mind, you're price agnostic, you just want to buy. That's sort of setting the scene. And that explains, to me, why gold was going up so much, but the gold stocks weren't, which was the big question that everyone was asking last year.
AdrianDay is a renowned international advisor and the esteemed editor of Global Analyst for his expertise in global investment strategies. Due to economic concerns, Adrian underscores the central bank's significant role in gold buying. In his analysis, he suggests that despite gold's price appreciation and potential monetary policy shifts, ETF outflows persisted, indicating a lack of enthusiasm for gold investment among Western investors. The gold price is also holding up in the face of continued outflows from gold ETFs, which continued in March for the 10th consecutive month, albeit slower. Goldman Sachs recently hiked its year-end gold price forecast to $2,700 per ounce from $2,300, saying the usual macro factors are not driving the metal's bull market. With Fed cuts still a likely catalyst to soften the ETF headwind later in the year, and right tail risk from the U.S. election cycle and fiscal setting, gold's bullish skew remains clear. Goldman Analyst said in a note. From a technical point of view, Adrian points out a recent development in the form of increased gold buying from Chinese investors due to limited investment options, which have turned to gold as a relatively stable asset. Moreover, Chinese investors have shifted to gold as a relatively stable asset due to concerns about the Chinese economy. Gold's record-setting rally this year has puzzled market watchers as bullion has roared higher, despite headwinds that should have held it back. With prices sagging this week, the explanation may lie in China. After weeks of debate about whether a mystery buyer was stoking the rally, several prominent figures in the global gold market are concluding that the significant new driving force is a legion of fleet-footed retail investors on the Shanghai Futures Exchange. Now we present the clips of AdrianDay's insights from his recent interview with natural resource stocks. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
All the indicators you want to look at were very weak other than for central banks. So it was central banks who were buying gold, and they were not buying gold as an investment because of the investment scenario, because the investment environment of interest rates going up and a strong dollar is, of course, negative for gold. They were buying as an insurance. And when you're partly, mostly, as a protection against the dollar, weaponization of the dollar. So when you're buying with that objective in mind, you're price agnostic, you just want to buy. Just as when you buy house insurance, you might shop around, but you don't say, I think I'll wait 6 months until the prices come down. I mean, you get the best deal you can at the time. So you're price agnostic. So anyway, that sort of set in the scene. And that explains, to me, why gold was going up so much, but the gold stocks weren't, which was the big question that everyone was asking last year. It makes sense because the central banks, the buyers of gold, wanted fiscal gold. They did not want Newmont. They certainly didn't want Ajax Exploration or Consolidated Moose Pasture. And so what we've seen this year is really interesting. What we've seen this year so far is only a very slight shift in that buying, frankly. We've had a new buyer that's Chinese buying. That came in this year, and particularly after the Chinese New Year. And when you think about it, Chinese are they're both concerned about the economy in China, and they also see potential for some monetary easing in China. But they're concerned about the economy, and they don't want to leave their money in the banks because the banks are unstable. And Chinese buyers, traditionally, if you look at the avenues where Chinese buyers go, they do like stocks, but stocks in China are way down. May be a good opportunity, but you and I both know that most people buy things when they're going up, not when they're going down. Real estate. The Chinese love real estate, but they're not going to be putting their hard-earned savings into real estate right now when they're concerned about the economy. So what do they buy? Bitcoin? Oh no, that's illegal. I forgot. So the only thing left is gold. So you can see Chinese buying of gold, both speculative buying from the Shanghai Exchange and also physical buying, has been very strong in the last 6 weeks. But you look at the other indicators that I mentioned, coin sales, ETFs, we've seen what I would describe as a modest shift. And I'm talking Western now, Western ETFs and Western coin buyers, US or North America and Europe. We've seen a shift, but by no means a sharp shift or a change in direction. So you look at ETFs, for example, January and February, every single week was net outflows from ETFs. Even though gold was going up the way it was, even though Powell was talking about cutting rates, astonishingly, still net outflows.
Despite the allure of investment returns, AdrianDay suggests that investors driven by apprehensions about the financial system prioritize physical gold ownership for security, in contrast to those who opt for ETFs or futures contracts. Furthermore, Adrian emphasizes gold mining companies' strong earnings potential and undervaluation, citing Agnico Eagle's price-to-free cash flow ratio as evidence. While caution is advised for heavily invested individuals, he advises that those underinvested or without exposure to gold stocks may find it an opportune time to buy. Gold prices are 14% higher for the year, and that should be able to push up gold miners, though that has yet to be the case. However, less inflationary pressures on the horizon could eventually push miners higher, thereby increasing trade opportunities. Furthermore, the big players in the gold mining industry are starting to show signs of strength. For example, Newmont and Barrick are seeing strength in a relatively slow start to the second quarter for the broader stock market. Let's get back to the interview.
I think we're seeing more and more people wanting to take delivery of their gold, not wanting to trust, intermediaries and paper gold. And maybe that's one of the reasons that the ETFs haven't been seeing the buying. I mean, I'm not one of those who thinks that I'm not one of those who thinks they don't have the gold. Maybe I'm naive, but they have audits by 2 different firms every year, and so. But anyway, if you're buying gold because you think it's cheap and because interest rates are coming down, and you think over the next year you can make 20% on your money, and you don't really care, why go out and buy physical and have to store it? Why not just buy an ETF or buy a contract on the COMEX? But if you're buying gold because you're actually afraid of the financial system, well, you want physical. The plain fact is that today they are pretty low, and the earnings, this first quarter's earnings and the second quarter earnings, should be pretty robust. When you've got gold at 2,200 or 2,300 as it is, today, even after the decline, it's over 2,300, and you've got all-in sustaining costs of 1,400 and 1,300. Those are robust margins.
Yeah.
So, and we tend to forget that. Now, I think the market is right to look at costs, because that was what killed us in 2011. As costs ran out and people were only looking at the price of gold, not at the cost. So anyway, I think they're very undervalued today. And I gave the example of Agnico's price-free cash flow, but I could give other examples of NAV and earnings and so on and so forth for other companies. So the stocks are cheap, and they're still nowhere near at their high prices. The industry is robust, and they are very, as I mentioned earlier, they are very, very undervalued. When the sector turns, let's not forget, we've all seen those comparisons of gold stocks versus Apple or versus Tesla, and they're definitely worth looking at. But I'll give you another one, if I may. The value of every gold stock in the world, including the exploration companies, is maybe $400 billion. You look at the largest gold mining company, which is Newmont, which is about, $50 billion?
Yeah.
Well, NVIDIA has had 10-minute moves that are 4 and 5 times the market cap of the largest gold mining company in the world. Tesla has traded more in a single day than the market cap of the largest gold mining company in the world. What I'm making is, when money turns into this sector, the stocks are going to move dramatically. Now, would I be buying now? That's always a difficult question, because when you're already pretty fully invested, I would say there is no need to increase right now at this point. If I was underinvested or didn't own anything, I would certainly want to buy.
China's central bank is ramping up its gold reserves. It's spearheading the record levels of central bank purchases of gold worldwide. However, gold prices have surged recently due to the increased retail investor activity in China. How do you envision the future of gold prices and mining stocks in the evolving market dynamics? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.